Good morning and welcome to the Intelligent Ultrasound Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And now I'd like to hand you over to Stuart Gow, CEO. Good morning, sir.
Thank you very much. Welcome everyone to Intelligent Ultrasound's interim results for 2024. Okay, so I think just to summarise, obviously we've had the major bit of news in July was that we have agreed with GE for them to acquire our clinical AI ultrasound business for 40.5 million cash. That is subject to regulatory approval from the UK's National Security and Investment Authority and the Competition and Markets Authority. It is expected, though, to complete by the 1st of October. So we're expecting that approval to come through in September and then a completion on the 1st of October. The deal is an implied value of 12.4 pence per share on our current issued share capital, and that's just under 34 times multiple on the 2023 revenues for the clinical AI business. So I think that, generally this has been seen as a good deal for the company, which was why we recommended it to shareholders, and they passed it at the general meeting last week. So obviously the other bit of news that you'll be interested in is what our interim results are. These have been now displayed as continuing and discontinuing operations, and I think the summary, Helen's going to take you through this in detail, but the summary is that it was a disappointing first half. We declined by 18%, some of which we had flagged earlier in the year. So revenue of 5 million compared to 6 million last year. The simulation really was the big impact on that, with sales down 22% to 4.5 million compared to 5.8, and cash overheads reduced. So we did, make some cost savings, and continuing operations were 3.3 million, and the discontinued operations were 1.1, totaling 4.4 for the group against 4.9 last year. That did reduce our cash burn in H1 to 2 million rather than 3.8 of 2023, and left us with 1 million cash as at the end of June. So if I just take you through clinical side of the business. So this is obviously just to try and explain to you what's going and what's staying. So the part that's been acquired by GE relates to our solely AI software that's moving. Software and hardware, but the ones that's it's dedicated to AI only. There are three key products that are moving over. There's the software that drives the GE Healthcare Sonalist. I think everyone knows about this. We've been talking about this product for a number of years. Towards the end of Q1 this year, we were put on this software was launched on the Voluson Signature, which was the final key ultrasound machine within the women's healthcare range from GE that has put our software on. It went on as a standard feature, joining the Expert series and the Swift series. We have our own product called ScanNav Anatomy PMB. This is all about doing live anatomy highlighting for peripheral nerve blocks. And we then have a third product that we had announced at the end of last year. This is a pre-regulatory approved product, which is called ScanNav Fetal Check. You may have seen that this had been used by the Bill and Melinda Gates Foundation for a number of trials in Africa, and would also sold a few units to a number of trials for universities in Africa as well. So in the first half of the year, that revenue doubled from 0.2 million to 0.4 million. And that's they're the products that will be going to GE, along with the team that do all the AI development, the data, and all the agreements and images, etc. So the complete clinical AI side of the business that has been acquired. What isn't moving, though, is our needle trainer product. The needle trainer product was a sort of AI hybrid product. This is all about teaching doctors how to do needling, but incorporated the ScanNav Anatomy PMB trainer version. So i.e. the product you don't have to put through regulatory approval. And that was That is being licensed back to us and will be included in the needle trainer product going forward. And that is moving in effect back into the simulation side of the business. So will be retained by us as we move forward. We have a number of new launches done this year on the needle trainer product. And that has made up the majority of what we had traditionally called our clinical AI sales. So that did revenue in H1 of 1 million, which had doubled from 0.5. So we see a real growth potential in the needle trainer range of products going forward. So that's the clinical AI product. What is staying, obviously, is now the simulation business. So our continuing operations is simulation, but including the needle trainer product. If you look at the top there, there's now a really strong lineup of product. Scan Trainer is an obs and gynae. The compact range has extended that out. We've got the HeartWorks products in heart and lung, BodyWorks for point of care ultrasound, BabyWorks for neonate and pediatric, and then Needle Trainer for all forms of needle guidance. So a very strong range of product in the simulation. And although we've had a disappointing first half, revenue down 22% to 4.5 million, with in effect the UK was the major part of that, down 58%. We had flagged this before. Well, to be honest, towards the end of last year, definitely flagging at the beginning of this year that, the impact of the junior doctor strikes on budgets within the NHS has been very difficult for NHS budgets to then plan for CapEx expenditure. And so I think the whole market has seen a reduction in CapEx spend where you've had sales related to the NHS. It's not just us. You've seen major manufacturers having exactly the same issue. So sales considerably down, although I think we see that this is going to change going forward. So we see, we believe there will be an upturn where the UK is going to recover back to the sort of levels that it was in 2025 going forward. A slightly unexpected decline of sales in America. We had expected sales to be at least as good as last year. We had some last minute product which didn't get out through the cutoff point, but also some purchase order delays from some major orders that took longer than expected and are still being pushed through. So that impacted our sales in America. And I think we also had a number of new areas that we're selling our simulators into, and we had hoped to have the first sales coming through. They have taken longer than we thought. Sometimes there is a lag between launching into new areas, such as the CRNA programs, such as the emergency medicine use of the needle trainer, and our new products going into nursing and clinical critical care. And so that lag basically impacted our first half. And because of that, IUN has been down 23%, which, as I say, was unexpected and, clearly obviously disappointing. Positive, though, is that the rest of the world sales up 37%. We've been quite strong in the rest of the world, especially in China, Germany, and the Gulf states. So we see that as a real positive. And then sort of looking forward, obviously the work that we've done in the first half of the year on our simulation R&D has enabled us to extend the cardiac range that's for BabyWorks. We see BabyWorks being a very strong part of our future growth, 25, 26. But we've also launched new functionality for our BodyWorks simulator, which is to put needling onto this product. You may ask, why do we do that? We've got our own needle trainer product. Our needle trainer product is all about teaching on live volunteers, so you can understand how to scan in a live environment. It's completely different to a simulated environment. You're actually putting on a real patient, scanning with a real probe, and then putting a simulated needle in them. So a really important part of learning how to needle a live person, but with a needle that obviously doesn't go into the volunteer. What that doesn't do, though, is show you different pathologies. So it just teaches you how to scan on a normal person. It's quite important to learn about pathologies, how you handle pathologies clinically, and needling on Eve enables people to do a similar thing, but seeing pathologies on our simulator, our BodyWorks simulator. So we see that as being a big growth area for 25 and 26. And then the third development that we've brought to market and launched is a new endometriosis product called Endometriosis Plus. We've put that onto our compact simulator. We think this is going to open up a new market. We think this is a very important area of women's health, where diagnosis is really important. Ultrasound is an important part of that diagnosis, but it's not easy to do. And this simulator is all about teaching you that. We see that as being an important growth area for the next couple of years, so 25 and 26. So when you look at those three products together, this really gives us a strong simulator range going forward. So as I say, although we've had a disappointing first half, and 2024 has been all about the deal with GE, etc., and difficulties in the UK, we think that going forward 25 and 26, we see this range as being a strong range for future simulation revenue growth. As I've said, from the new products that are added on to all the existing products in the range. And the final one at the bottom is the needle trainer product having a portable version, which we think can open out new markets for the needle trainer device going forward, especially potentially taking it into the military and rural clinicians. So that is the simulator product range for going forward. There are a few other points to note about the board changes and ESG. So on completion of the GE transaction, Nicholas Sleep, who's one of our directors, the CTO and COO, he is will be resigning as a director and joining the GE healthcare team. Otherwise, we've got our third ESG report, which is in the 2023 annual report and accounts that we just released in May. We continue to instigate new initiatives in this area, promoting better employee and local engagement, and we think we're having a really positive impact both locally, nationally, and globally, and that remains an important part of our messaging. The other area clearly that people are interested in and want to know about is that, what will be happening after the sale of the clinical business in October. So it is our intention to make a material return of capital following a review of the growth potential and capital requirements of the simulation business that remains. We are taking obviously comprehensive legal and tax advice on the structure of a return, and we expect to make an announcement detailing the proposed use of funds, the future strategic direction of the simulation business that will be made by the time of the completion of the transaction. And that is expected, as I've said, to be in October this year. Right, so that's a summary of the business. I'm now going to hand over to Helen, who's going to take you through the detail of the accounts.
Okay, thanks, Stuart. So I'll just start with an explanation of the basis of the presentation of the financials within the interim report. So where a business is in the process of being sold or has been sold, it needs to be presented into a discontinued operation and a continuing operation. So we've restated our prior year and our full year 2023 and presented our 2024 results in this way. So that means that the traditional simulation segment that we previously reported is now within continued operations, as well as the needle trainer revenues and costs. And then on the right-hand side, we've got the discontinued operations, which is the business that's being sold to GE Healthcare. That's presented in the income statement as one line, just a loss after tax figure. And then in the balance sheet, where you are going to recover those assets through a sale rather than through continuing use, you're required to present that just on one line, the assets and the liabilities. So that's what we've done in the accounts for the first half of the year. So just the highlights of the first half, I'd say it's been a mixed period. Obviously, simulation revenues have declined by 22% to 4.5 million. But our clinical revenues in the discontinued part of the business have doubled to 400,000, with the royalty income there continuing to increase quarter on quarter. Our group admin costs have reduced to 5 million from 5.1 million, and I'll go into a bit more detail on that. So of that 5 million, 3.95 relates to our continuing operations and 1 million relates to discontinued. We have had some cost savings in the period offset by some cost increases, and I'll go through that when I talk about the income statement shortly. So cash at the end of the period was just under 1,950,000, which meant that we had a cash burn in the first 6 months of 2 million. That compared to 3.8 million this time last year due to working capital variances. So significantly improved compared to that period. So Stuart's already talked about the variances on a regional basis, so I won't really go into too much more detail on that. Just to so the continued operations, the gross profit was 2.6 million, which was a gross margin of 57%. see that's 4% lower than this time last year. And the reason for that is because of the higher proportion of rest of the world sales, which are through resellers, which obviously generate a lower gross margin. We also had differences in product variance mix, so that also has an impact on the margin. From a discontinued operations side of things, the gross profit was 400,000. That's a 95% gross margin. That's largely because it's 100% gross margin software related revenues within that, but also a few costs from the PMB and the fetal check products, which slightly bring that below the 100% margin. So just onto the income statement. So the group revenue was 5 million, split 4.5 from continuing and 0.4 from discontinued. So that gave us a gross profit of 3 million for the group. So I've just given some detail there as to the split of our administrative costs. So they came down overall by 300,000 on a group basis. So of that 5 million, 3.95 related to our continuing operations. And if you add back the non-cash costs of depreciation and amortization, that gives you roughly an EBITDA of £500,000 loss based on a 4.5 million revenue. So our operating loss for that business is 1.4 million, but our group operating loss with the discontinued was 2 million. So you'll see that we made a number of cost savings in the first half of the year, despite 300,000 of higher costs arising from higher amortization and annual pay rises. We started also to incur a few costs in relation to the transaction, which are in the discontinued side. But we made a decision at the start of the year in order to mitigate the risk that the UK market would be down to kind of delay and pause certain R&D projects relating to the clinical AI business, as well as any marketing exhibition spend where we might not have been successful in prior years. We just paused that to be able to make sure that we mitigate some of the loss in revenue. So overall, we saved about £500,000 in the period by that lower spend, as well as not replacing levers in the clinical AI part of the business, and also Ian Whitaker, who left at the end of last year. He was our commercial director. We didn't replace him, so that's also contributed to the cost savings in the period. So from a balance sheet perspective, our net assets were 8 million at the end of June. That decrease from December is largely due to the cash burn in the period of 2 million and lower trade receivables and payables as a result of lower trading. You'll see the asset held for sale of 2.2 million and the liabilities of 9.5. So the 9.5 is the intercompany loan effectively owed from the clinical AI business to the remaining parts of the business, the investment that the business has made in the clinical AI business since its acquisition, which will be repaid following the sale. And so that concludes the financial review. I'll hand back to Stuart to summarise.
Thanks, Helen. So I think, in summary, look, we've sold the clinical business to GE. We're obviously subject to regulatory approval. And I think that we've spent the last 7 years, I think, successfully creating first-to-market AI products. And we've built, a strong capability in the AI image analysis sector. So we're pleased that this achievement has been recognised and that generally this has been well received by the market and by shareholders in terms of the return that we achieve for that investment of 4 times return. I think the remaining simulation business is going to be boosted by the inclusion of the needle trainer range. It's growing strongly. It's generated 1 million of revenue in the first half of this year. And I think that, as I hopefully explained on the slide that shows the range of product that we have in the simulation business, is that even though we've been focused on the clinical side and growing that, we haven't stopped investing in the simulation side of the business. We've kept that business going. And if you look at the business together last year, it was a 10 million revenue business. We do see that the range of products that we've got, there is room for growth in that, in all areas of the business. The UK has had a difficult time. We expect that to recover in 2025. We expect to get growth in the US in 2025, and we expect to continue growing in the rest of the world. So we think The simulation business as a standalone business has still got good growth in it, and can clearly be a profitable business going forward. So as part of the review of that, and to see how the post transaction business looks, we're doing a comprehensive review of the business. It is our intention to make, as we've said, a material return of the capital once we've reviewed the growth potential, capital requirements of the sim business, and also how we can best return that cash from a legal and tax perspective. And we look forward to making an announcement on that, about the proposed use of the funds and the direction for the company post this sale, when we complete in October. So that concludes the presentation, and I'll hand back to take questions.
Stuart, Helen, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. If I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Okay. Right, so looking at the questions, I'll read them out and then we'll try and answer them. So first question is, can you provide more details on how the proceeds from the sale will be utilised, specifically regarding the mentioned material return of capital and any strategic investments that might follow? So I can't provide more detail at the moment. This is what we're going through currently. We have committed to coming back at the time of completion to give you more detail on obviously exactly what we're proposing to return and how we see the business going forward, and any structure or any investment that might be required to achieve that. But we'll give more detail, we would hope, by the 1st of October, when we're expected to complete. And I'm sorry I can't say more now, but that's what we're working on. So second question, with the needle trainer product now included in the simulation business, how significant do you expect this product line to be in driving future revenue growth? So I think we've got a really good range of product in the company. I think the needling side of the business is a really interesting area, that we've got a strong range of products now that we do expect to be a driver of growth for the business going forward. It's why we've invested time and resource in developing these products. It's why we've invested time to make that product a broad range that can fit all areas of the clinical ultrasound guided market. And we do expect that to drive revenue growth. So, you know, it has grown strongly. Having £1 million of needle trainer related sales in the first half of the year, I think is good evidence of that. And we'd hope that this will be a significant platform for us going forward. And I believe that where the market needs guidance and help justifies why we've put this money investment into the product range, and why we think that product range can give us growth in 2025 and 26 going forward. I also think that the range of products is also strong as well. It's not just about the needling product. There's a full range of products in the simulation marketplace for ultrasound. You know, we are seen as being a global leader in how you teach ultrasound. And, you know, the role for us is to, in effect, get that growth back in the UK and make sure we now continue the growth in the US going forward. So I think 25 has the potential to be the business to come back and show good growth and make the simulation side of the business now, which is the focus of our business, and keep that growth going and building a profitable business around that. So considering the administrative cost reductions, do you see further opportunities for cost optimization within the remaining business segments without impacting growth or innovation? So I think clearly there's always the potential to make savings within a business. I mean, I would say that if you looked at what we've done over the last 5-6 years, we have really juggled well, being given enough money to grow and invest and do R&D and try and protect our cash. It's not easy at times trying to juggle those. We've been obviously well supported by our shareholders. But also we've always had to manage the fact that we've got just enough to do lots of different things. And I think we have got a team that understands how to juggle that. But I think there is always opportunity to look at where you can optimize what you're doing depending on what the strategy is going forward. And I don't think, we haven't discounted anything in terms of saying, right, okay, what can we do to this business? Priority is the business has to be profitable as a simulation business, but also where are the parts of the business that you could invest in to get even more growth out of the business by extending into other areas. These are all things that are under consideration, but I do think there is the opportunity to make continued optimization of the business as it currently stands. What are your thoughts on international expansion? What are the opportunities and challenges? So I think the good thing about the business is that when you look at the structure and the business that we've built, is that we do have an international business now. We've got our own business that sells direct in the UK. We've got a team that's selling direct in the US, and then we've got a reseller network of over 20 resellers around the world selling into sort of 30, 40 countries. That's already in place, and it's about how we optimize sales using that structure. So I think clearly there are certain countries that we can do better in. We're really encouraged that we've had a really good response to Needle Trainer in China. I think that's been great, and a good example of us working with resellers and a new reseller to help make that happen. So I think clearly there's always areas that we can do better. We're working very hard on France and how we can improve France and Western Europe. But I think when you look at the global business, the structure's in place to achieve sales growth. And I think that's the important thing. But obviously there are always challenges on how you manage that, how you invest in that, and how you support that on a global basis. I think we've done it well to date, but we're clearly always reviewing what changes we can make and how we can improve things. Can you please highlight some of the key considerations that will input into the strategic review of the simulation business? So I think that, it's fair to say that without committing to what we're thinking and what we've actually currently done, the important thing is to look at, we have a core business that we've built here. This is a business that in 2023 did 10 million pounds of revenue. And, for businesses that are growing, that's not an easy thing to just achieve. And so we've got a base to build on. So part of what we are clearly reviewing is that base something that you would just, right, well, take what you've got and keep it as is and just make it as efficient as possible to be profitable? Or are there areas where you can then extend what we're doing? So we're obviously an ultrasound specialist. We cover the high fidelity end of the marketplace. Is there any way of extending that range in simulation to achieve future growth in other areas of the marketplace, which we're not necessarily in now, but we can see can have future growth and considerable growth in the marketplace? So reviewing that. Reviewing, are there other areas of the business that we can extend into? So we've clearly over the last 7 years built a classroom side of the business that we've managed to take £9.5 million of investment and then turn that into a 40 million sale. So are there other areas that we could do something similar in that relate to the business that we've already got and that we can add to that business? So that's another area that we're obviously reviewing, trying to do again what we've done in the just achieved and extend the business out based on what we've currently got, the current core skills, the structure that we've got, and how can we add elements to the business to extend this business out? Because this is all about ultimately getting better value for you as shareholders. The idea is that it's not just this is the end. We've sold part of the business, therefore it's all over. This is about how do we continue this growth and get growth from the whole business and business that remains. So we're reviewing everything possible we can in the period to make those first few steps on that, come back and tell you what the idea is in terms of what we're intending to return to shareholders, and then what we're intending to do with the remaining business and the cash that we're required to do that. And having clarity on that by the end of October is our aim, or at least being a first step on that path to telling you that information. And final question is, who are the main competitors to the sim business? Is the market opportunity sufficiently large to justify the company continue as a separate entity and carrying the costs of being a coded company? Or should you look to sell the remaining business as well? Is this something you will consider as part of the strategic review? Well, I think, the honest thing is that as a business, it's always possible that someone buys you. I think if you look at our business, we are seen as being a leader in this sector. The simulation sector is a large one. We're in one of the verticals within that. I think the size of the business can support being a standalone business, but clearly we need to grow. The business can't just be a 10 million pound business. It's got to find the ways of taking the current product and growing them, and then adding new product and continuing that growth. We want this business to be 15, 20 million pound revenue business, and a profitable business going forward. But clearly you've always got to look at how do you fit within the marketplace. There are competitors in this space. You've got Surgical Sciences as a competitor. You've got what was CA Healthcare but is now called Elevate in this space. We've got low cost competitors to us who compete in a different end of the marketplace, people like Sonosim, for example, and a whole range of competitors that are sort of across the range. But we have carved out a space in this marketplace where we're seen as being one of the leading companies in ultrasound high fidelity teaching. We still believe there's a market for that, but we do believe that actually there is growth potential within that, and also the ability to extend into other areas. So I think that absolutely the business can carry on as a separate entity, but obviously it has to grow to cover the costs of the central costs that you have as any business. Has got to make sure that all those are covered by us growing this business. But we're always considering everything as a business, as you would expect us to do. That's the last question.
Stuart, Helen, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Stuart, could I please just ask you for a few closing comments?
Yes, well, I think the main thing is thanks for everyone for listening. Obviously there's been a big change this year. We're looking forward to this completing, and then us to be able to come back and give you the direction that the business is going to take going forward. And I look forward to doing that hopefully in October. Thanks very much.
Stuart, Helen, thanks for updating investors today. Can I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Intelligent Ultrasound Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.